Hello and welcome. Today we are taking a look at APLY, which is the Yieldmax Apple Option Income Strategy ETF. The Yieldmax ETFs of late have become very popular and for a very good reason. They offer some insane distribution yields in all their ETFs, as we can see on the screen, from anywhere between 14% to as high as 50%. And for this reason, a lot of people are excited, but at the same time, some people are a little concerned about how sustainable these yields are. And I think Aptly might be a good long term sustainable ETF among all of them, all the ETFs that Yieldmax is offering right now. Yes, it does have a much lower distribution rate as compared to Tesla or NVDY. But I think this might just be a silver lining for this ETF because in the long term, it might be able to provide a more stable NAV and sort of avoid the NAV erosion, which is a common feature in a lot of these covered call income strategy ETFs. Towards the end of the video, I will also be discussing an alternative to this ETF, which also has Apple as the underlying holding, and it offers around an 8% yield. But at the same time, that ETF gives you the opportunity to sort of participate in the capital gains of Apple stock, something that the Yieldmax ETFs do tend to miss out on. So, lots of information to discuss. Let's get started. So, the main reason why I think Aptly might be somewhat underrated among all the Yieldmax offerings is because this distribution rate that you see right here is not exactly accurate. It only reflects the most recent distribution that happened in the month of September. But so far, Yieldmax have given out 4 months of distribution for Apply. And if you actually go down and check all the four distributions, what you will find is that the distribution which happened in the most recent month of September was actually the lowest among all the four distributions. And that may be the case because probably the volatility of the Apple stock was not very high in the past month, resulting in a lower distribution for the month of September. But that may not always be the case in the upcoming months. Surely, we are going to have some months where the volatility for the stock is going to be high, which would result in higher distributions. So, the distribution rate currently displayed on the website is not exactly a great indicator of the fund's potential. And we can actually prove this by taking an average of the four distributions so far and calculating the annual yield on the average of the four distributions. We would actually end up with a distribution rate very different from what we see on the website. Let's quickly do that calculation. So here we have a calculator, and I'm going to quickly add up all the four distributions we have received so far. So 0.2256 plus 0.5555 plus 0.633 and 0.288. So that's the total distribution they have given out so far over 4 months. We divide it by 4 and we get the average monthly distribution. And now you multiply it by 12 to get the average annual distribution based on the four distributions so far. And lastly, we would divide it by its current share price, which is 1898, to get the average annual distribution based on these four distributions that I've given out so far. And when we calculate the percentage, we get 26.9. So that's a distribution rate based on the average of the four distributions so far, which is actually almost twice of what we see on the website. Because again, as I said, that is only based on the most recent distribution, the one displayed on the website. But this average sort of indicates the actual potential of this fund. So the most recent distribution is not an indication of how the fund is going to perform in the future. but it simply indicates that the most recent distribution was just lower because of certain market conditions, which may or may not be similar in the upcoming months. If you like the content so far, don't forget to like, share, and subscribe. It helps the channel out. Alright, this brings us to the second important factor, which I believe why APLY might be the best offering from Yieldmax right now. And that factor is simply the fact that APLY is the least volatile ETF among all of Yieldmax offerings. Like if you compare the underlying stock Apple with any of the underlyings of the other ETFs, it is the least volatile stock. And I know what you're thinking, that these income ETFs are designed to sort of generate income through volatility. So higher the volatility, the more income we receive. So how is it that Apple with the least volatility, giving out the least distribution, is the best stock? Well, the reason being that a shortcoming of such ETFs is the fact that they capture all of the downside during a down market for the stock, but when the market is doing good, they fail to capture the upside because they're trying to generate the income, so they have to sacrifice the upside for the stock. And a lot of these stocks are actually like really high growth stocks. So they are going to have a lot of upside. You would end up sacrificing a lot of the upside. With Apple, I don't think that's the case. Apple doesn't really have too much of an upside to grow. I mean, sure, it can continue to grow in the future, but we are probably not giving up too much of an upside with Apple. And the other thing is, because Apple is less volatile, even during a down market, it would probably not go as down as some of the other stocks within these ETFs. So, like, let's do a quick comparison with Tesla. Say during a bearish market, Tesla, I don't know, goes down by 30%, whereas Apple only goes down by 10%. So when the markets turn and become more bullish, Tesla would have a more difficult time recovering from a 30% down position as opposed to Apple, which is only down 10%. A common feature with these ETFs, which is the NAV erosion, mainly happens because stocks are too volatile, and then the ETF sort of has a difficult time recovering from a down market. I think with Apple, we would not have that difficult time because it won't be down even as down as the other stocks, even during a bearish market. Now, this is only my prediction. I do not know what is exactly going to happen in the future, but there is some evidence supporting what I say among ETFs, among similar ETFs that have been already active in the stock market for several years. So let's take a look at those ETFs. So those are the Global X ETFs, which have been actually very popular for several years now for providing passive income through the covered call strategy. The two which we are going to look at, as you can see on the screen, are QYLD and XYLD. And as you can see, the QYLD ETF covers the NASDAQ 100 index, whereas the XYLD has the underlying as the S&P 500 index. And both these funds were introduced in 2013. But over the past 10 years, QYLD is down 31% in terms of its capital value, whereas XYLD is down just 0.74%. So it's practically unchanged. So it's basically trading at the same level where it started in 2013. And during this time, on average, QYLD has given out around 11 to 12% dividend income, or just the covered call income, whereas XYLD has given out around approximately 9% income. And we can see the reason why again. NASDAQ 100 index is a lot more volatile, as opposed to the S&P 500 index. So it is no brainer that we end up receiving more income through the Nasdaq 100 covered call. But in this case, we are also losing a lot more NAV value, or the net asset value of the fund, whereas in case of S&P 500, we have almost unchanged. And there were in fact instances where the NAV was above where it started trading. So in 2018, it was around $52. Again, in 2020, it was around $52, which is above the $40 trading price it started with. Whereas with QILD, it never actually crossed the $25 trading price that it started with. So what does this tell us? Again, because the Nasdaq 100 index is a lot more volatile, it ends up going down a lot more during the down market and then has a difficult time recovering. And by the time it recovers, there is another down market, due to which the NAV never really gets a good opportunity to recover. But S&P 500, because it is not as volatile as the Nasdaq 100, does not end up going down as bad as the Nasdaq 100 index. So even in the worst case during 2020, it was down to $35, which is just $5 below its original trading price of $40. And then it again recovered up to $50 in 2021. So this basically shows us that the S&P 500 index, when we use the covered call on it, is able to recover better as opposed to Nasdaq 100, even though it is giving out a slightly less income. I think in terms of NAV, it is in terms of preserving the NAV, it is doing a better job. And I think APLY would somewhat work similar to the S&P 500 covered call ETF, especially when it comes to preserving the net asset value of the fund. So those are the two factors why I feel APLY might be a really good investment when compared to other offerings from Yieldmax. Number one, it has the potential to deliver better distribution rate compared to what we are seeing on the website right now. And number two, it has the potential to better preserve its net asset value when compared to the other ETFs with more volatile underlying holdings. So that is my review of the APLY Yieldmax ETF. As promised at the start of the video, I will be sharing with you an alternative to this ETF, which also has Apple as the underlying holding. This other ETF also uses a covered call strategy to generate income, but this alternative is structured very different from the Yieldmax Apple ETF, where it allows you to sort of get an 8% annual yield, but at the same time, you also get to participate in the capital gains of the underlying holding, which is Apple. So this ETF is the Apple Yield Shares Purpose ETF. Now, those of you who are in the US, this ETF currently trades only in the Canadian dollars. So you would have to buy it on one of the Canadian exchanges using the Canadian dollars. But I think this is a really good alternative to APLY. And quite interestingly, it has the same ticker symbol APLY. However, if you are planning to search it on Yahoo Finance, you will need to use aply.ne to differentiate between this and the Yieldmax APLY. So as we can see, we have an almost 8% distribution rate over here. Their management fee or the expense ratio for this fund is actually lower than Yieldmax. But at the same time, what we see over here, they're writing covered call on 50% of the holding. And on top of that, they are using a 25% leverage. And interestingly, they are actually invested in the actual Apple shares, unlike Yieldmax, which uses a synthetic strategy to sort of mimic the price movement of Apple shares without actually owning Apple shares. So we can see a very different fund structure from what we have in Yieldmax. And what this results in is that you are able to get this 8% distribution through the covered call that they're writing on 50% of the holding, but the remaining 75% of the holding, which we can say, which also includes the 25% leverage, is just capital gains for you to get whenever the stock goes up. So when you really think about it, for on average, every time the Apple stock goes up by 1%, you could expect this fund to sort of go up by around 0.75%. And I think that's a really good combination if you're not just looking to preserve the net asset value of the fund, but if you want to actually get some capital gains in terms of the net asset value as well, in addition to your distribution, then this might actually be a really good alternative to APLY from Yieldmax, which is only offering you income without any real potential for any kind of capital gains. I will be making a more detailed video about this ETF and how it functions and how it is different from APLY. So if you aren't already subscribed, do make sure to press the subscribe button so you get all the future updates of the videos I'll be making in the future. We have lots of these income oriented ETFs coming out, so there are lots of things to discuss and analyze. So make sure to subscribe, and thanks for watching this video. See you in the next one.